Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Dan Teran, managing partner of Gutter Capital. Gutter is an early-stage firm based out of New York focused on founders tackling the world's toughest problems. Graduation rate of their founders from seed to Series A is 3 times the average, so they must be doing something right. We talked about why Gutter invests with conviction, why they seek out founders with unique insights rather than Gutter trying to dream up their own, and how AI can solve problems in the real world, not just online. Please enjoy. Dan, thanks for coming on the show.
Yeah, my pleasure. Great to be here.
Now, I know that startups are all beautiful and unique snowflakes, but you guys have, I feel like, some pretty strong points of view with how you invest. And so I thought I'd just start with a question of what does a classic Gutter company look like?
Yeah. So, we're a pre-seed and seed investor. So we're investing in early stage companies. Primarily today are investing in vertical AI, vertical SaaS marketplace businesses. And I think in terms of what the company does, we tend to be most drawn to companies that are solving problems in the real world. I would say, the Gutter founder is pretty unique. We like people that have deep experience from either their professional life, their personal life, and have come to an insight pretty naturally. So I would say folks that went to Stanford Business School and sat at a whiteboard until they found a business idea are probably better suited for other firms. Our founders typically don't have the pedigree of a Silicon Valley founder, but we find that they have a really authentic connection to what they're building and their insights. And so, often we think about like insights that are overlooked and people that are underestimated kind of tends to make a great Gutter setup. And then given that we have a lot of experience as operators and we've kind of built the firm to do the work, we don't mind getting into situations where, there's a heavy need on the recruitment side, or usually there's something a little funky with the opportunity when we get involved, but we feel like we're the best fit to fix it. And that makes for a really great spot for us.
How do you tease out finding founders who aren't part of the traditional venture funnel? How do you find that? How do they find you and how do you find them?
That's a great question. I think, it's funny, like if you had asked me 4 years ago when we started the firm, I would have said, and I did say that founder referrals, are kind of the fuel for our fire. And that is true. But actually in the last 2 years, it's really flipped that cold inbound is like our biggest driver of deal flow. So, I think we probably get the same 1,500, 2,000 cold inbounds that every other firm gets. But I think the way that we prosecute them is a little bit unique. And so for the last probably 2 or 3 deals that we've done, these are folks that came cold inbound. The insight was interesting. The founders were interesting, but it wasn't quite there. We give really clear feedback and we keep the door open for founders to keep us informed and to engage. And there's a deal that we're working on now that like literally it's been like a year since we gave feedback to the founder, and we love nothing more than to be proven wrong or just to have like the feedback addressed. And so sometimes we won't hear from a founder for like 6-9 months, and then they'll have done everything we asked. And, they've showed us a lot about what they're like to work with. But the deals are, all over the place. My partner, James, and I were in Karachi, Pakistan last week, working on an opportunity. So really like keeping a very broad aperture and just trying to find excellent founders and interesting insights.
I was going to ask about geography because we're co-invested in a company out of Utah, and judging from, a non-Stanford chasing strategy, it would make sense that you're more spread out. Are there any spots where you're particularly heavy?
I had the good fortune to kind of come up in like the kind of second wave of New York tech. And so, my background was as a founder in the ecosystem here when there just wasn't a ton of venture, and before there were many firms in New York and there weren't a lot of founders here. And so I would say I have like a certain draw for New York-based founders, just kind of having been a founder of a pretty big company in that era. So we have an office on Canal Street in New York where there's 50 people across 10 companies. And so we tend to serve as like the nerve center for the portfolio. And sometimes that's companies that are based in New York, headquartered here. And sometimes that's companies that are based elsewhere. And we help them to build very strong teams, specifically in product and engineering, that are based here in New York. So, in the last fund, we've done deals in Richmond, Virginia, Chattanooga, Tennessee, Cincinnati, Salt Lake. So all over the place, but probably the other half is New York.
I want to come back to the strategy piece, but this feels like a natural time to talk about Elbow Grease, which is a new accelerator that you guys launched. Can you talk about what Elbow Grease is about and the spark for getting that rolling?
I'm thinking about where to start because we're in the middle of processing 616 applications. And so before I got on this call, and as soon as I get off, I'll be back into the thick of it. So Elbow Grease, it's a hardworking AI accelerator based in New York City. It's a residential program. So we'll pick 5 to 10 founding teams and they'll work out of our office and alongside us. The inspiration for it, so there was a couple things. One was just looking at what's happening with AI. The cost to build a company is plummeting. The aperture of who can build a company is broadening. And so we wanted to make sure that we were positioning ourselves to see really interesting founders and ideas as early as possible. So we're investing 300K for 9%. We want to get there early. And hopefully if the companies perform, I think what's unique to Gutter, our strategy is we will lead the subsequent rounds. That's like, we'll do the pre-seed and then the seed. And in this case, we'll do Elbow Grease and then the pre-seed and then the seed if we have the opportunity. It was a way to structurally make sure we're seeing really good stuff early. And the other piece was, we looked back at our successes in Fund 1 so far, companies like Opus, Bicky, Forerunner, Faraday. They came out of a time when it was before we started the fund. I was advising founders for a little bit of equity, helping them to recruit their founding team from my network, and just giving them a lot of hands-on coaching and support, navigating investors, navigating the product market fit. And we just kind of thought about like, what would it look like to create a program that tries to recreate that with that level of like intention and focus and density and community. And the answer was Elbow Grease. And yeah, we are, I would say, a third of the way through reviewing the application process. We've got a few companies that we've already offered and have accepted. And I'm like, I could not be more excited at the quality of the companies that are going to be in the program.
Oh, that's great. That's really nicely differentiated. I've said on the show before, there are probably a few hundred too many accelerators that are out there, and they mean well, and I'm rooting for them, but most of them, it's not a great value add if I'm just being really straight with people other than desk space and a little bit of capital, but that's great and certainly stands out. On the AI piece, I'd love to hear a little about, I think when most people think of vertical AI or AI just in general, they tend to think of, I don't know if I'd say dev tools, but very developer centric, very online centric and less real world. Can you talk a little bit about how you picture AI flowing into real life, everyday problems and solutions, and what excites you about that?
We tend to stay away from dev tools and kind of productivity stuff. Software that's being built by people who are heavy consumers of software tend to get very competitive very fast. What's most interesting to us is where when software and now AI meets the real world is where things tend to break. And so there's actually a lot of defensibility if you can actually execute well in kind of pressing software into parts of the economy that haven't been penetrated. And so we think about that as like online to offline interactions, sometimes connected hardware, sometimes there's a high level of orchestration needed to actually get the job done. And these are things that are just like, I think, unlikely to be consumed by the base models. And so we find, hopefully a little bit of safety there. Obviously, could be very wrong about that, but that's sort of our theory of the case for now. Some examples. So we have a company that's in our fund too called Faraday, which is building AI agents for the back office for HVAC contractors. So things like managing all of their equipment data based on photos that techs submit, actually preparing and filing permits, processing rebates, filing warranties. These are like all job functions that somebody who sits in the back office of an HVAC company has to do. And they're pretty repetitive, mundane tasks that are pretty well suited to an AI agent actually just executing on. We have another company called Rebuild, which is AI for post-disaster reconstruction. And so the process after, the apartment I'm in, I had a flood because there was a fire upstairs a few years ago. What happens after that event is the insurance adjusters come in, they take a ton of, either a Matterport scan or a DocuSketch scan, like a 3D scan of the space. And then it goes to an estimator who sits and actually uses their expertise to go through the scan and figure out what it's going to cost to rebuild. Building a computer vision model and workflow tools that basically allow the software to generate with very high confidence the actual estimate that can then be submitted to the insurance carrier and then actually negotiated with the insurance carrier. And so, we think of that. That one's really interesting because they have both computer vision doing some work and then voice AI in the field that's actually the computer vision model is asking the human in the field, could you give me a little bit more detail about those cabinets? They look like they might be an IKEA finish. Like, is that right? And so you actually have like this very beautiful man-machine interaction where the humans in the field are helping kind of get to the last mile required to create a high fidelity estimate.
That's great. Do you ever go like off deals that are straight down the fairway for you? I don't know what your level of discipline would be with staying on that, or do you give yourself some leeway?
I think where we have a high degree of discipline and are pretty inflexible is around valuation. Our average entry price per fund 2 is 11 million post money, which I think is pretty unusual for seed stage fund these days. And I think where we have a lot of flexibility is like the domain. We are pretty dogmatic that we don't have any good ideas, and the founders are the keepers of the insights. And so I think one thing that we've done very differently from other accelerators with elbow grease is like, we're not telling people the ideas that we want them to pitch us. We're keeping it a very broad aperture. And so the domains that our companies span are pretty broad. Obviously, there's some things that we just like don't know about, and it's going to be hard for us to learn enough about to get to conviction. And so there's a little bit of like concentric circles where we build up our competence over time. But yeah, I would say like, we're looking at a company now that's doing AI drone software for forestry operations. And like, there's a lot of there's a lot of things in there that we don't know anything about today, and we've had to spend a lot of time learning about. But then the deals tend to build on each other. So we've done a lot in electrification and electric vehicles. And so we start to become a little bit more expert in those things. And so those things feel comfortable, but then we're looking at a business now that's in the aggregates business, which is like gravel and sand. And we relish the opportunities to learn more as well.
You mentioned there that you're dogmatic about the founder being the one with the insight. And to contrast that, there's some firms that are well known for, they frame it as having a prepared mind where they go deep on an area, they have a specific thing they're looking for. Can you talk more about that point of view and how you guys think about the founder being the one with the insight rather than the opposite?
There's a lot of strategies that can work in venture. And I think like the time that other firms spend preparing their mind, we spend helping founders. And I don't think that there's not enough hours in the day to do both. I think that like we just don't know enough about the world to have like a high degree of certainty on what the best ideas are. But people who have worked in industry, so for example, like, Soundtrace is a company in Fund 2 where they do audiometric testing for industrial facilities. The founder there, Jeff Wilson, is exceptional. He not only grew up kind of having a personal experience of workplace-induced hearing loss, but he also managed the hearing conservation program at Cintas and was actually like the person who was responsible for administering the program and saw how broken it was. Like, how in the world are we going to come up with that? And that kind of led us down this path of discovery where we learned that 1 in 6 American workers will lose their hearing on the job. It's the largest occupational illness in the United States. It, increases the cost to insure someone by 50%. We were like, this is a huge problem. And, we had no idea. And so we had the opportunity to learn from that founder. And, that's kind of a classic Gutter story. And now, we know a ton about it. We work really closely with them, but there wasn't an idea that we were going to come up with.
Hunter Walk, who was on the show recently, is one of your LPs, mentioned on LinkedIn recently that your LP letters show a love for founders and their businesses, and it's very clear. Can you talk about how you think about your relationship with your founders, kind of in the trenches, but also broadly with supporting them?
Yeah, I mean, I think like to state the obvious, like I was a founder myself. I did it for 5 years. I started Managed by Q when I was 24. I didn't know anything. I was fortunate to have great investors and to build a great team. Satya Patel from Homebrew was on my board, so he kind of watched me grow up before his eyes to the extent that that happened. And I have a deep empathy for founders because it's lonely. Even if you have like co-founders and you have a great team, as a founding CEO, like the burden is squarely yours, and that's a lonely road. It's also really hard. I think like if founders are doing it right, building a startup will take everything you've got. It's sort of like is an infinite game. And I think we just try to show up for founders in a way that kind of honors that reality. But it's like, they're the founders, I'm not. So we're there to help, but we're also not like we don't have any delusion that like we're, in the same boat as them. It's like they've chosen a very hard road and we're here to help them, but it is, their company to run, which I think is an important distinction.
I agree. Jason Friedman was on the show recently, and he talked about how a lot of founders underestimate the difficulty and stress and everything that goes with selling your company. It's a lot bumpier than they realize. You've sold a company that you founded, Managed by Q. Can you talk about what you learned from that experience?
Oh yeah. I mean, there's like so much to unpack there, and honestly, like every exit is different. And so I also, then ran M&A at WeWork, and I had done a few acquisitions at Managed by Q. I've seen all sides of it. I think one thing that I know is like, there's different archetypes of transactions, but like they are all very different. And so, my experience was very unique. I had built, Miguel, who's one of the founders of WeWork, is a good friend. He had introduced me to Adam years before the transaction took place. And, built a relationship there, built a lot of trust. And I think it boils down to like, one, there was like a principal to principal relationship. Two, we kind of collectively arrived at an understanding that Managed by Q was an answer to their question. And I think that's like really important in any M&A. And then I think like in terms of learnings, one of the things that I think we did well was make sure that I knew that there was risk in selling to WeWork, which as it turned out, there was a lot of risk in selling to WeWork.
Correct.
And it was really important to me to make sure that because I was making that decision for the team, that they weren't exposed to the same risk that I was. And so, I was very proud that our team got compensated in all cash and at close. And the way things shook out, I doubt that many people would be rushing to work with me again if I hadn't done that for them. Today, there's like close to 40 people in the Gutter portfolio that worked at Managed by Q. Like a third of the founders in our first fund were Managed by Q employees. And so I think the most important thing for a founder to consider is like, what are your priorities going through a transaction? And like, you really do have to make hard choices. I ended up making trade-offs that like certainly sacrifice parts of my own compensation and like comfort to make sure that the team got taken care of. And, that's paid dividends. And so I think going into a transaction, like you got to really, be clear on what your priorities are because people are going to make a decision whether or not they want to work with you again, whether or not they want to fund you again. I'm fortunate to have Hunter and Satya as LPs and a bunch of my former employees as founders.
Should founders spend time trying to build relationships with logical potential acquirers?
I think it's your job as a founder to be creating optionality constantly. There's very rarely is it a good outcome if it happens fast, and if you wait until you need to sell the company, like it's going to be painful and likely nothing gets done. Companies are bought, not sold. And so, but there's a lot you can do to make someone want to buy your company. I think in my limited experience and kind of like somewhat broader knowledge of M&A, the best deals are done principal to principal with us, like a relationship built over time with like a really clear strategic rationale that can make people overlook the economics because otherwise you're like going to get valued by a banker. And for most startups, that's not what you're looking for.
We were talking before the show, the venture market's unusually top heavy these days with the amount of money going into large funds. Can you talk about why you're being very deliberate on keeping fund sizes at a low level?
What we have seen over the past couple of years is sort of a great divergence in what funds want because, you have this insane amount of capital flowing to the 30 biggest firms. You have like, I forget the stat, but it was like 20% of the entire venture market going to OpenAI. You just have like this serious concentration of capital and big funds need to write big checks. And so that's happening on one side of the market. And on the other side, you have early stage startups, which is like two founders with an idea. And they are able to get further than ever with very little capital. So they're using code generation tools, they're using AI-enabled sales outreach. All of the things are making it cheaper than ever to build a company and get to significant revenue. And so when you have this divergence, there's a big disconnect. So like the interests of the funds are now divergent from the interests of the founders. And so we wanted to put ourselves in a position where we were able to write reasonable checks, get meaningful ownership, and then get our ownership early enough that we're always on the same side as the founders because it is just true that we're seeing companies get profitable sooner. And we had a mandate to write a $100 million check into one of these companies. We would probably be not fully aligned in what's right for the company. We have a few companies from our second fund that are already profitable, that are growing on a venture trajectory. And like we own 25+% of the company. We don't care if they raise more capital. In fact, we'd prefer they didn't. But that's a consequence of a strategic decision that we made with regards to fund size and stage at which we invest.
One of the ways that Getter is very hands-on and serving founders is around sourcing talent. Can you talk about why that's such a big focus for you and how that's evolved since you started the firm?
Yeah, I mean, so I kind of like came by the insight around talent, honestly. Like I said, I started Managed by Q when I was 24. I was incredibly fortunate to get some amazing people around the table that really taught me how to do my job. They had all worked. Had never really done anything before. And so they all kind of helped me figure out what I needed to do to be a great CEO. And then after I left WeWork, I mentioned kind of prior to the fund, I was advising a few founders, specifically Rachel Namath at Opus. I introduced her to her two co-founders, Jeff Silver and Vince Lee. Abhinav Kapoor at Bicky, I introduced to his two co-founders, John Lucas and Chris Thompson. And I just saw those businesses start to inflect when these incredible, purposeful, mission-driven founders were surrounded by the right talent to actually build the product. And I saw it raise their ambitions. And so it became very clear to me that in a lot of cases, especially when you're dealing with founders who don't come from Silicon Valley pedigree, getting the right people around the table can really transform the outcome and the upside and really everything. And so when we started Gutter, we thought about how do we replicate the successes that we had working with those founders. I, at the time, had a really good relationship with Richard Hughes, who had been my head of talent at Managed by Q. And we had him do he did some contract work for the portfolio. And then he basically pitched us on joining full time. And it was the best decision we ever made. So Richard was day one an operating partner at Gutter. And he's now recruited over 100 people into the portfolio. He embeds as sort of head of talent for the portfolio. We think of graduation as when they get past Series A, so he's more advisory at that point. But by the time a company raises a Series A at Gutter, we have probably placed 75% of the headcount on their team, and that does a few things. One, it's like we're actually showing up with a solution to the problem. Two, we get a lot more information when we know everybody on the team. We're really informed when it comes to making follow-on decisions. And three, like the talent bar is just higher. Like the average talent level in our portfolio is high because Richard, myself, James, we're all involved in the hiring process. And like we've just done this before. And so that I think makes a big difference. We can help them avoid a lot of the mistakes that I made myself.
Gutter always takes a board seat when you invest. Some founders pre-seed seed, they get anxious, have pushback, uncertainty about having a board when it's really early. Can you talk about the importance of that and why it's a must for you?
Yeah. I mean, I think, we learned from great mentors. So like I mentioned, Satya Patel led my seed round. He joined the board. At the time, it was, I would say, even more unpopular for seed investors to take board seats and to even like have board meetings. And it really did change me in the business to have a board and to have board meetings and to have this regular cadence of getting off the trail and reflecting on the progress in the business and talking about kind of the bigger picture. And so I think it's really important for companies to get that hygiene as early as possible, and having a formal board as a forcing function for that. I have just seen like now in our experience, like companies that have excellent board materials and excellent board meetings from day one, by the time they get to raise the Series A, like there is such a trail of artifacts of how they've prosecuted the business at every step that it's just like makes it very easy for downstream investors to underwrite because there's evidence of how they've navigated every problem. And it provides a very compelling preview of what it's going to be like to work with them, which I think is a big positive. And the other thing is it just creates like a cycle of feedback on like learning from problems versus keeping your head down and doing more of the same thing when maybe, a turn in the road is needed.
You've been a founder. You're on at least 9 boards that I can count now. You've spent plenty of time in the trenches. Over that time, and maybe since you've gone through that journey of being a founder yourself to having backed them for years, are there traits that you look for in founders now that maybe you wouldn't have a few years ago?
Yeah, I mean, definitely. So we have a pretty intentional process for evaluating founders. It was something that we've iterated on over the years. It was like we only learn through painful lessons. So somewhere around like tail end of Fund 1, we introduced our founder assessment process, which is often like 2-hour interview, very structured, focuses on early life, family life, career progression, values, very, very long and detailed conversation about kind of who the person is. We then have those interviews reviewed by a third-party executive coach who only works with founders, who actually does the scoring. And the 3 traits that we're looking for are integrity, drive, and judgment. We have found that when those 3 things are present and strong, we have a really productive working relationship with the founder and things go well. And when any one of those things is absent, it doesn't end well. And so those are really the 3 things that we're looking for.
We were talking before the show about portfolio construction, and you alluded to some of this earlier, but you'll invest in around 15 companies in a fund. How did you come to that number? Was it back solving off ownership targets and the fund size you wanted, or was there a more top-down view of the level of diversification you wanted?
So we are very concentrated. I think our view is that the need for diversification in early stage is overstated. As Warren Buffett says, diversification is a wonderful strategy for people who don't know what they're doing. We basically did analysis on a ton of data that we got from an institution and then our own 110 angel investments prior to raising the fund. And my partner, James, is a computer scientist by background, also one of the world's most successful professional gamblers. And he ran an analysis basically creating random portfolios out of all this data and saw that the returns to diversification really kind of flatten out at, I think his number was 12 or something. And I think we did 15 to make our LPs more comfortable. But yeah, we don't really believe that you need to be that diversified. And we believe strongly that diversification comes at the cost of being able to actually change the trajectory of companies. And so there's a huge value. We do 5 or 6 deals a year, and that gives our whole team and me the time to really work closely with the founders and help them navigate through the early years of the company, which so far the evidence is pretty good. Our fund one, our graduation rate to Series A is over 3 times the industry average. Could be luck, but I think it probably has to do with the work that we do.
That's awesome. I love it. And I also happen to have a similar target for similar reasons. This has been a really fun conversation. I really love what you guys are doing. I always like to end with, what's a conventional view in venture that you think is bullshit? It sounds like you have many, and we've touched on some.
How much?
Maybe, yeah.
Well, I'll give you kind of 2 briefly. One is, I think second-time founders are overrated. There is a mania right now where large funds want to fund a second-time founder building an AI company, and they want to write them a huge check for reasons previously discussed at the pre-seed or seed with basically no traction. I just think it's preposterous that a second-time founder, regardless of how successful they were the first time, they're basically making the bet that they're 10 times more likely to succeed in some cases, just based on the price, than somebody who's never had a shot. And based on our strategy, you can tell which side of the bet we're taking. Would rather bet on someone at 6 post than assume that it's de-risked because they've done this before at 60 post, whatever. Maybe those numbers are a little extreme. And so that's the first one. I think second-time founders are overvalued, and I say that as a second-time founder. And the second one, which I think is just very core to the Gutter ethos, is there's sort of this alluring myth in Silicon Valley that the best founders don't need help. And it's just comical to me how much that's obviously not true. And you could look at Google, you could look at Apple. There's just so many. It's who are they talking about as the best founders if they're not talking about Steve Jobs? And anyone who's read their history on the relationship with Sequoia would know that they were heavily involved. You needed a ton of help. And that's okay. Our view is we're looking for those people and we want to help. And I think it's a very convenient point of view that the best founders don't need help. I think a better question is are most investors qualified to help them? And so, yeah, that would be my second take.
That's great. Well, look, Dan, this is really fun. I appreciate your coming on the show.
Awesome. Thank you so much for having me. Really nice to chat.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, or your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Atrios. Atrios enables companies to get warm introductions to potential customers and rewards the connectors who make those introductions. A study by Nielsen showed that referred customers are 4 times more likely to buy a product when referred by a friend. And I'd bet that goes even higher as AI slop starts to pile up in our inboxes. If you'd like to get warm introductions to customers or get paid to make warm introductions to your network, visit atrios.com to learn more. That's atrios.com. Thanks for listening.
Joe Mager is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.